Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I've got Michael Markowski, CEO Money contributor and director of research. All right, Michael, thanks for being here.
Hey, it's great to be with you always again.
You always have some enlightening stuff to talk about, and you've got some big stuff you talk about today, right?
That's right. What I want to talk about today is the changes in the capital markets, that the non-public capital markets are actually becoming liquid. And I want to explain how that is happening. I know it's hard for people to grasp. Wait a minute, private equity becoming liquid? How's that possible? Well, first of all, let's talk about how it happened. After the crash of 2000, when the dot-com bubble burst, there's never been another IPO since that happened of significant IPO, what we call venture stage IPO. Yahoo, eBay, Amazon, all those companies came public as venture capital plays. Their stocks rocketed by over 100 times in the late 90s after they did their IPOs. Then after the market crashed, there's never been another big box type of venture capital play that's been underwritten by Wall Street. So what happened is that Facebook came along and was founded in 2003, and investors started putting money in Facebook and employees and all that other stuff. Well, Facebook, by 2008, there was no IPO. They didn't have the same opportunity as those other ones before pre-2000. So the shareholders needed to get liquidity, the employees needed to get liquidity. So 5 years later, these private marketplaces emerged that enabled large investors, accredited super wealthy investors, to buy and sell the shares or buy the shares from the employees and the shareholders of Amazon on these exchanges. One was Second Market at the time, was one of those exchanges. And another one was Shares Post. So actually what happened with Facebook, and then that went on, and the shares of LinkedIn, Facebook, and a whole group of those social media companies first were listed on this private market, and billions of dollars traded in the private market of those shares before their IPOs.
Right.
So you could have, people were buying and selling Facebook shares at a much higher valuation than its IPO, prior to its IPO. So what happens next? What happened next is then we have the crash of 2008, 2009. And with the crash of 2008 and 9, that all of a sudden calls for legislation, to prohibit crashes in the future. So Congress passes Dodd-Frank, okay?
Right.
And Dodd-Frank was the kiss of death for now the public markets, for the small public companies in the marketplace. So it pretty much killed that marketplace for small public companies. And the reason why is because Dodd-Frank, for the first time, made it criminally liable for brokers to recommend stocks, or small stocks, mid-sized stocks, to their clients. So prior to Dodd-Frank, if a broker recommended a penny stock to a client or a low-price stock, the broker could do that, and the broker didn't have any criminal liability. It was all covered through civil arbitration and all that stuff. So with Dodd-Frank, the broker could no longer do that. So the brokers have left the small cap market. So penny stocks, very, very brutal. I advise people against them. There's 1 in a million that I would ever recommend, and I do occasionally recommend one, but people should not be dabbling in penny stocks. This chart here that I'm showing you, look, right, this chart here, it shows what happened, and this shows you the difference. This is the low price stock index compared to the S&P 500 over this time period, and you can see the peaks and the troughs for the two. Then all of a sudden in 2014, after Dodd-Frank is implemented, you can see the wide divergence between the big caps and the small cap stocks, low price stocks. And so the other thing about Dodd-Frank, it's created a bubble in the large cap stocks because all of the broker dealers became wealth managers, and instead of writing tickets for commissions, they're now getting them. They're asking money management.
Yeah, fee based.
Yeah, it's all fee-based. So guess what? Back in the days, when I was a broker and I started in 1977, there was no such thing as fee-based. Half of the guys in the room would think the market's going down, and they'd have their clients in cash. The other half of the guys would have they would think the market's going up. There was always some liquidity buffer. Now everybody's in the big cap stocks. They just keep going up, going up, going up.
And they're investors, they're not traders now.
Right, but the point is their advisor is not going to ever. What's the incentive for the advisor to tell them to sell? If you got $1 million and instead of taking a commission, I'm getting a 1% fee and I'm the broker, and I'm getting a 1% fee, why should I ever tell you to sell?
They don't.
If I tell you to go into cash, I'm not going to get my 1% fee. If I say, hey, let's get out of the market and let's go into $500,000 out of the million in cash.
Even though they're supposed to be fiduciaries, they don't.
That's right. They don't. And guess what? Under Dodd-Frank, if the whole market crashes, they're not to blame because the whole damn market crashed. Okay, so they're not. So Dodd-Frank, they're covered under Dodd-Frank. That's the whole thing. So what the crazy part about this, Mike, is that the one thing here is crashes. Okay, cause changes and they perpetuate themselves. With the crash of 2000, eliminated the IPOs. Crash of 2008 brings in Dodd-Frank. So what's the answer?
Jobs Act?
Well, what happened is the Jobs Act came in 2012, and the Jobs Act changed the whole regulatory climate for private companies. So under the Jobs Act, now the public, for the first time since 1933, millions of people, everybody in the United States can now invest in startups, okay? Because of the Jobs Act, it can invest small amounts, but the other thing that the Jobs Act did is when you invest in a startup on an SEC-regulated platform, those shares are automatically liquid a year and a day later, okay? And they don't have to ever be listed on an exchange.
Right.
So here's what's going to change. Here's what's going to change. Right now, and this is the difference. Right now, people speculate. There's speculative real estate and there's commercial real estate. Okay, speculative real estate, when a guy goes out and says, hey, honey, I think they're going to put a new freeway in 25 miles out west here. Let's go out and buy about 10 acres of land over here where I think that real estate, where that freeway is going to come in. They got to the populations, but they got to put major thoroughfares out in that area. So let's go out and buy that real estate. Let's plant a stake on it. Let's pay 10 grand for it. Let's put a stake on it for sale by owner and wait for somebody to pay us $100,000. That goes on all the time.
Right.
That's called speculative real estate. Right. That's what the public wants in the same thing in stocks, and that's what this is going to allow them to do. Now, who's going to allow them to do this? There's two companies, Start Engine and Choice Trade, which are both on the leading edge of this. Start Engine's a crowdfunding platform, an SEC-regulated crowdfunding platform, and Choice Trade is an SEC-regulated online broker-dealer. Choice Trade, as we talked before, is the first online broker-dealer to get in to be able to have their clients buy and sell startups in their portfolios. So with these two, really, there's no reason for anybody to have to go and put their money in penny stocks when they can go into these private markets.
Great.
Okay?
Brilliant, Michael. Thanks for being a guest on today's show.
Okay.
You're welcome.
Okay.
All right, you've been watching CEO Money with Michael Yorba. Thanks for joining us. We'll be back with more content for you soon with our contributing editor, Michael Markowski. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.